Okay, well, I think that session neatly summarised some of the practical experiences that are being confronted by policy-making authorities on some of the issues that we've been dealing with over the last couple of days. I have two questions for the panel before opening the floor. The first is again, I mean, we had the theme of this positive correlation between house prices and happiness, and I noticed that Swedish people are 50% happier than Lithuanians, and I don't know if that's only about house prices, but I guess that there are some other factors at play as well. But it's clear that from some of the empirical work that we've been seeing, that this correlation actually does manifest itself in impacts on real economic activity. People consume more when house prices are higher. And in fact, in the Jordan work that I showed earlier on, I mean, I made the case for credit in my own presentation, but it's clear from the Jordan work that you still have macroeconomic spillovers when you have house price booms and busts, even when they're not funded through credit. And of course, the question is, how should macroprudential policy deal with that? Well, deal with the fact that households seem to have, there seems to be some myopia in household behaviour. Willem Boyter had a very nice blog that he published in the FT about 10 years ago explaining why housing was not net wealth, because the only way in which a household could realise the wealth would be either, well, if it had a second home that it could sell, or if the household took a decision to trade down or even move out of the housing market altogether, which, by the way, some of my Irish friends did before the bubble bust in Ireland, moved from household ownership to household renting. So I'm just wondering what the panelists' thoughts are on how macroprudential policy, or should macroprudential policy take this macro channel into account. The second question that I have, it hasn't really been touched on so much so far, but given where we are, I don't want to get into monetary policy now in a great amount of detail, but given where we are in the interest rate cycle and the likelihood that we're going to be seeing at some stage, I don't know exactly what horizon, but it's more likely that interest rates are going to rise in the future than that they're going to decline. How should macroprudential policy take account of interest rate risk that households might be facing? So, whoever of you wants to answer on those.
Yeah, if house prices are correlated to happiness, we've had an emotional roller coaster in Ireland in the last 20 years, which is very informative, I think. Largely credit driven at the beginning, but at the time of introduction of our macroprudential measures 2.5 years ago, we had extremely subdued credit conditions at the same time as we had house prices rising at 20-25% a year. I think Tomas alluded to this yesterday. Regardless of the source, if house prices are rising at 20-25% of the year, or if there are very evident imbalances in the housing market, I think macroprudential policymakers need to be concerned. I think it is clear from the evidence that the worst financial crises are linked to both imbalances in credit and housing markets and the link, but I think housing market imbalances, first I think they will often lead to credit market imbalances. I think if house prices are increasing by 20-25%, even if credit has not yet taken off, it is very likely to come down the road. And this was our concern 2-3 years ago. The risk that there was an incipient credit bubble, that the conditions were now in place, that the rate of house price increase, the expectations channel, the speculation channel was there. And I think in those cases, policymakers need to err on the side of caution. I think the consequences, as the Irish example shows, of housing market crashes, financial market crises, are so severe that I think policymakers need to act early in that situation, even in cases, which is not the norm, where credit conditions are subdued. And I think the link in terms of, with macro policy, I agree with what you were saying earlier, it's not the same as a business cycle. I don't think you have your eye on smoothing GDP. I think you have your eye on longer-term financial stability, both the structural element and the cyclical element. I think it's inevitable. Interest rates, obviously, just on the second. Well, maybe we'll discuss the first point first, if you want to.
Okay, thanks a lot, Mark.
So I would agree, and I think already referred that there is a case, I think, for us to consider that at least not targeting, but maybe to try to dampen housing cycles because of all the various reasons which I presented. So, and because the side effects, also the macro channels, I think that they're, well, in the Lithuanian case, we don't know how strong this wealth effect is. So, for example, the impact on construction activity, it's you need really to do serious research on that, but it's probably there. And in addition to other sort of effects, probably we should seriously be concerned if, of course, there are many conditions, so really many factors need to be checked, but I think there is a case.
Kasper?
Well, I think it's important to think what can macroprudential policy do that other policies cannot do, and when can it do things that other policies cannot do. I think it's really important to go back to what's the underlying friction. And structural policies take time. I mean, I think Sweden is an example of it. We have a huge housing construction gap that is not going to be resolved. Even though housing construction is going up very rapidly, it will take time before these new houses come on the market, and the lack of supply will be there for years to come. And I think in situations like that, macroprudential policy can do things. But as some of the other speakers said, I don't think we should have expectations of moving prices or having major impact on prices. I think what we can achieve is some kind of resilience, but I think we should be very aware of it, that macroprudential policies are basically business cycle related policies. And we should not sort of have and I'm not saying that people do that, but it should be very clear, we're not trying to stop cycles. I mean, cycles will be around, crises will be around. It's all about reducing the likelihood or reducing the impact of negative shocks to important markets. Do you want me to move on to the interest rate at once? Or?
Maybe just...
Well, I think Mark was going to say, you were going to say something on the interest rate issue.
Yeah, well, I think the policies we're discussing today are particularly important in this regard. I think they're supposed to, to safeguard the system to any type of financial shocks, income interest rate, house price shocks being the most obvious. I think a number of countries stress test interest rates now at origination for higher interest rates. So I think macroprudential policies are the obvious policies to mitigate the risks that are coming ahead. I think policymakers know what is coming down the line. They can stress test affordability, ensure resilience as best they can, but it is clearly the prolonged length of the low interest rate environment also increases the risks that are coming down the line. So I do think there's risks coming.
I think it's obvious. It's very beneficial when these borrower-based requirements are in place. So individual borrowers are more protected. The indebtedness is managed, and for the interest rates would go up for monetary policy reasons. So there was a case to raise them in the first place, but monetary policymakers will be sure that actually there will be no, so to say, side effects, undesired effects, because that's kind of managed. So here, both policies will help each other.
Kasper?
Well, I think I'm going to revert to my general argument about the underlying frictions. I think even with low interest rates, I think the same question, it begs the same question. What is the problem that we're trying to solve? Well, it could be that with low interest rates, banks and loan officers have a hard time assessing risk because they're assessing risk in an environment that they basically have no experience of. And so they may be underestimating real risks. It could be that households just have expectations that are not anchored in the reality, actually. I mean, if you ask certain people, what's your expectation about rates, they think that rates will stay as low forever. It may also be that there's just a decent amount of gambling in the market. You can make a lot of money investing in real estate at the moment, and some of those risks are eventually going to end up, with the government. And I think that may be a good reason for conducting macroprudential policies in a low interest rate environment.
Mm-hmm. I actually have a question to Kasper on the Swedish situation. I think monetary policymakers, they have a tradition not to talk about each other's monetary policy. In Macroprudential case, it's different. We talk about each other's policies, we discuss. So I'm going to ask, in your case, and the point you were making, because situation in Sweden and the difficult situation, there are lots of supply-side constraints, and these are structural issues which big politicians are not sort of willing to change. Rental market, building constraints, and other things. But nevertheless, despite that, and if we assume that risks are building up, continue to build up, and the eventual correction will be harder if nothing is done. So I think there is a case still to try to do something. This is what you're doing, amortization requirements and other things. So these, despite that, underlying causes are structural, but still there is a case for action. I think
No, I totally agree. Yeah. And I mean, we've been very vocal in proposing alternative policies, but I think it's good to keep. And I think, initially when, at least I think at Roszbach, when we were seeing this as sort of a short-term issue, we were hoping that quick policies were going to be implemented. I think as it has been taking a longer time for these structural policies to adjust, it's become more and more the focus of the debate that structural policies have to be implemented because in the long run, macroprudential policy is not going to be able to solve a housing shortage.
So the challenge is basically for you is now to engineer soft landing to avoid hard landing.
That's one way of formulating it.
Okay.
Quite a challenge. So let's open it up to the floor. Yes. I think what I'll do is collect 2 or 3.
Thank you. Adam Gersel, joined Vienna Institute. I would have a question for all 3 speakers related to effectiveness of the measures they presented in Ireland, Lithuania, as well as in Sweden. In terms of arbitrage and leakages, did you observe any kind of arbitrage behavior by the borrowers, be it in the European market, borrowing from abroad, taking mortgages from other countries, non-banks, or even things like pushing the price of the property upwards and the inflating income maybe, etc. And do you have like a experience with your supervision departments that they really check during on-site inspections, like individual credit files, like they do for corporate loans, whether the banks adhere with the idea of these regulations and not only, kind of, okay, LTV is 72, that's fine. Thank you very much.
Okay, thanks, Adam. I saw, Dirk and then. Yeah, okay.
I would have a question on the tax deductibility of the interest rates that are related to mortgage borrowing. I think in the Swedish presentation, I think there was this chart showing that eliminating tax deductibility would have a strong impact. And I think this is a question that also concerns many countries. If you take a pure taxation perspective, people will tell you, but it would be unfair to eliminate tax deductibility. So probably there would be a lot of resistance. So that would be my first point. And how optimistic you are regarding what could happen in your country. And the second aspect is that if you eliminate tax deductibility, of course it would have it would reduce the incentive to borrow, especially for new borrowers. At the same time, it would also reduce the affordability of existing debt, because people who have already contracted a mortgage would not anymore be in the position to deduct this. So how do you deal with this trade-off?
Okay, I'll take 2 more. Dirk here, and then Erland over there.
Thank you. Just going to Mark, you had a nice overview, and what I liked is that you don't change all the time the LTV itself, but the allowance, because that is an easier and a politically easier way to be countercyclical without changing the big print. I'm just wondering how you apply it. Do you catch each bank or each lender, including pension funds or insurance company, the same allowance, or can they trade with each other? So how do you get to your number?
Okay, and then we have Erland here. Yeah, okay. And then I hope we can manage a second round. But anyway, I think it's enough questions collected for the colleagues here.
So I have another question for Mark. So you had pointed to a finding that first-time buyers are less likely to default than others, than movers, as you call them. And of course, that's a politically convenient finding because you can adjust the limit for those. But I wonder, to sort of believe it, I wonder, what's the reason? Why would first-time buyers be less likely to default? Is there a story that you could tell? And also, secondly, how robust do you think is this finding as you move away from what is sort of a peacetime environment, and if you consider default risks in the presence of aggregate shocks?
Okay, I'll start with Mark.
Yep. Okay. For Adam, first of all, leakages, the possibility of leakages is obviously one of the things that all policymakers are concerned about. We're reasonably comfortable on this front, the main reason being that all mortgage lending is regulated regardless of the source. It's a regulated activity. The two types of leakage, there will be the possibility of brokers coming in and directly putting Irish borrowers in contact with foreign banks that wouldn't be actually based in any way in Ireland, so we monitor that. There's no evidence it's occurring. The other leakage would be that borrowers would borrow, for example, from credit unions, unsecured lending to go towards the deposits. That's very much supervisory engagement. So we're very close. The development of this policy is, while financial stability, the macro perspective would have taken the lead, it was very much in collaboration with the Macroprudential supervisors. They had invaluable input into the development, but also into the monitoring of this. So there's very close supervisory engagement. It's a very important issue. Tax deductibility, I think it's not so relevant. It was a very strong factor in driving the house price boom, the existence of tax deductibility. It's now been removed, so it's less of a factor now, but there were very strong findings about the fiscal determinants of the house price boom in Ireland, and tax deductibility was a very important source, and it's maybe more. The allowances apply for every individual bank, and there is no trading. It's a very I could talk all morning about the allowances. I find them extremely interesting. As you say, we haven't yet adjusted. The adjustments we made were not for the purposes of tightening or loosening. The adjustments we made were more about, the first review was more a review of the structural design of the framework, and we found some issues that maybe after 18 months, areas where maybe we thought we could improve the design. So they constituted a slight loosening, but they weren't a deliberate attempt to tighten or loosen. Down the line, when we do come to look at tightening or loosening, we would have the options of changing either the thresholds or the allowances. We could see good reason why we might choose the allowances, one being just that the limits themselves become established in the public mindset as to this is what's sensible LTV and LTI lending, but they apply to each individual institution. There will be no trading off. In fact, the banks came in maybe about 20% below the maximum allowances last year. We think that was probably just taking a little bit of time to get used to it. We've had interesting experience in New Zealand, which was the first country to introduce these type of allowances. That, it takes a little bit of time for the banks to get used to it. The first-time buyers, so this is a very robust finding. I understand what you're saying about the political acceptability. There's a societal impact here. There's very strong findings. First-time buyers are more affected than others by loan-to-value ratios. First-time buyers, they have to build up their own savings to get a deposit compared to mover, second subsequent buyers who get the advantages of capital appreciation. It's also the case, you could say from a societal perspective, that it's more important for first-time buyers. For first-time buyers, what is at stake is getting any home from mover. It's a change from one home to the other. So I understand what you're saying. The findings are extremely robust. We will obviously monitor these over time, whether they're warranted. The findings about lower credit risk are extremely robust. There are some findings in the US which have similar results. We're hypothesizing potential reasons for this finding, so we cannot be definitive. But there are a couple of possible reasons. From the perspective of the borrower, the first-time buyer perhaps Given that his first time, maybe he has more of a concern over credit risk. Maybe he himself has built up these savings. The money for the deposit has not come from capital appreciation, it's come from his own savings. The fact he's a first-time buyer perhaps means that he will be more careful about his credit history, about any blemish on his credit history. From the bank's perspective, banks may put more effort into evaluating the credit risk of a first-time buyer. There may be a more rigorous approach to evaluating the first-time buyers. So there are possible reasons why this may occur. But in terms of the findings, these are from wartime. These are not from peacetime. These are the mortgages that were issued pre-crisis. These are a large number of mortgages issued before the crisis, but that have defaulted subsequently. There were no defaults really before the crisis hit. There have been very few defaults on mortgages issued after the crisis. So what we're talking about here are the mortgages issued pre-crisis that subsequently defaulted.
Just,
okay.
If I may
Thomas?
sort of reflect immediately on that. I think in other countries, in France, for example, 2 years ago, the research was presented. So really, first-time buyers, they have lower probability of default for various reasons. But my question actually, why you decided to have those exceptions and so sort of these softer requirements for first-time buyers, the argument could be as follows. So we have requirements for macroprudential reasons, but this is social function. This is actually for the government to do, and the government should introduce targeted subsidies, but not by within the macroprudential measure. Sort of, the argument was that this actually de facto, this is lower credit risk, so we have justification to have sort of softer requirements. But there's another way, for example, so that the government would, as for other subsidies, for other political, social purposes, they would just, whatever, offer some money or directly, but not the macroprudential authority would come up with such solutions.
Well, so the societal issue, the equality issue exists, the distribution issue exists. What our rationale related to overall credit risk. If you think about first-time buyers, if a first-time buyer has a lower probability of default, then it can be acceptable to accept a higher loss given default or LTV in order to equalize credit risk for a given exposure at default. That's the rationale. It's a credit risk argument. I'm referencing the reality of the other arguments, but not in terms of what our motivation was.
Okay, very interesting. Kasper, do you want to join in on this?
Sure. I think only two questions apply to Sweden. One was about arbitrage leakages. So I think a few things can be said about that. One is there's this risk of if you introduce LTVs, for example, there's this risk that people start doing unsecured lending. We've been looking at that. It's actually quite hard to follow that because people might be going to a second bank and taking an unsecured loan, and they might not do it at the same point in time. So it's hard in the data to see if people are linking that together with their house purchase. But we don't think that's happening to any greater extent in Sweden. I think one thing that does happen, and that has some distributional aspects to it, is that people start borrowing money from their parents and their grandparents. And I think that is an important feature of these kind of policies. And LTVs, in that sense, have much more inequity than DTIs or amortization policies in that sense. I think it is good to keep in mind that a lot of these policies that stop people from borrowing too much through whatever way eventually work in the favor of people who are restrained because it tends to dampen house prices. And those people eventually, even if you do this sort of modeling-wise, but also intuitively, eventually that will be good for their consumption because we think that prices are at a high level and that will prevent them from going through a phase where they're actually losing money on buying housing assets. But there are two things that are happening at the same time. One is that we have this sort of small or big, we have a fintech movement. So you have a lot of online lending at the moment. And so we see two things at the same time. There may be policies that induce people to do unsecured lending. At the same time, we have some new technologies where people in general have greater opportunities to do unsecured lending through intermediaries online. And it's hard to separate those two things. I think the last thing that's worth mentioning is that how binding certain policies are also depends on other institutional features. So, for example, in two countries that I have an easy time comparing, Transaction costs in the Netherlands for buying a house are very high. They've gone down, but they're still high. Transaction costs for buying a house in Sweden are very low. So the easier it becomes to flip your apartment and to move from one place to another, the less binding certain policies will be. I mean, so if you introduce LTVs, it just becomes a lot more attractive to sell your house when prices are going up with 15% a year, and you'll just be avoiding the policy that way. That's not a technical leakage, but you're changing behavior because of policies. So I think looking at policies in an institutional context, I think is really important. Second thing was about tax deductibility. I think tax deductibility is unlike LTVs. It is not unfair towards certain generations. It hits everybody to an equal extent. It is important, of course, that policy is predictable. I mean, if people have taken large loans assuming that there will be interest rate deductibility, it's important that you have some kind of phase-in of the policy. Otherwise, you'd just be creating bigger problems. But I think that if you think of the fact that we're in a very low interest rate environment and that people in this very low interest rate environment are building up very large debts, that's not only a financial issue, it's also a fiscal issue after a while. Once interest rates start rising, the fiscal burden of interest rate deductions will become substantial. So I think even from other perspectives than just financial markets or consumer protection or households, I think it's also important from a general economic or government policy that we look at what the long-term impact of interest rate deductibility will be. And that, I think that speaks in favor of building off these kind of tax benefits. Thanks.
Okay, thanks, Kasper. So the
well,
screen is telling us time's up, but I think you wanted. I'll give you the last.
I could reply to the last two questions.
Yes.
Yeah. Okay, try to be brief. So in Lithuania, in the case of LTVs, there is a requirement for banks to check that really the borrower has accumulated that the down payment are sort of personal money. But it's very difficult to check to ensure. And indeed, we have evidence that the people were simply taking unsecured loans, because consumer lending companies were not required to report to the credit register those amounts. So there was a way to circumvent that. So people were to go to take a consumer loan, present it to the bank as a down payment, and to get a mortgage. But after transposition of Mortgage Credit Directive, all the so to say mortgage lending activity is regulated now. All non-banks have to register and to follow the same responsible lending standards as we call them here in Lithuania. So the opportunities are substantially diminished, and at the same time, consumer lending companies now also have to report most of the loans to the credit register. So it's very difficult now. And at the same time, Lithuania is a small market, so the chances of cross-border arbitrage are minimal, basically. And regarding Adam, your question about the inspections. We had that question, and actually last year we undertook the first inspection, how our supervisors checked how banks are complying with. The findings were interesting. It was just more, I would say, an investigation. It was not inspection where the fines were issued. It was more to learn, because many requirements, they are sort of framed as recommendations. And what became clear, you really need to be specific. Banks want to know what is really binding, what is a hard requirement, what is a soft requirement. And there were lots of cases where banks had always very good explanations why they behaved or sort of deviated from a baseline in various cases. It was really interesting meeting all the cases presented, very interesting explanations, I have to admit. So, but we did that, but this is a lesson. So when you have those, especially principles-based or recommendations, you have to think what you want to be in sort of a really hard requirement or what soft requirement, because then it's unpredictable. Effects might be very difficult to predict. And the second question about interest rate tax deductibility, we are very fortunate. We don't have that issue. It was removed in the aftermath of a crisis as one of the crisis lessons. It's gone. We are so happy as policymakers. But I think it's relevant that this, I think it's in English, it's called grandfathering. So the people who took the loans, they had expectations so that they could be able to deduct, they still have it. And until it's sort of phased out. But I think it's a big distortion. And it's important to have it probably removed. Yeah. Thank you.
Okay, well, thanks a lot. So I think we can adjourn the meeting, and we're going to have lunch now. I don't know whether you want to Where is the lunch taking place?
It's right here.
It's right here.
Yep.
Okay, so
Oh,
let me thank the panel for fantastic contributions. And we're back in 1 hour, I think, is it?
Yes.
Yeah.
At 2 p.m.
2 p.m.
Yes.